I want to start off with you and get your take on what's going on in terms of the interest rates. What do you make of these huge moves, and are we nearing a top at all for 2 years and 10-year Treasury yields?
Melissa, I don't think we are anywhere close to the top. I have been saying for a long time yields will keep going up. It was out of consensus. I'm out of consensus again. We are going to hit at least 4% on the 10-year. And the other point about yields, since you asked about it, is the fact that the 2 to 10-year yield, after inverting minus 56 points yesterday, we are steepening today to about minus 43, minus 44. What that means to me is that the bond market anticipates the recession in the first half of 2023 and is already looking forward to the eventual recovery. That's what happened in 2006, 2007. We are following the same pattern as we did that time. Second, this is not just a recession, this is a stagflation. And in a stagflation, both bonds and equities are losers. And I've been saying this for several months, Melissa, and that's what we are going through right now. And we have further to run in this stagflation than we have so far. The last point is the dollar is just king. It's absolutely dominant. Becky spoke about it earlier in the program as well. And we saw the UK paper, 5-year paper, increased by 55 basis points just today. What this says to me is that we need to get prepared for a September 1985 type Plaza Accord, where the 5 major countries in the world, United States, West Germany, France, Japan, and UK, got together in the Plaza Hotel in New York in order to weaken the dollar. There is going to be some kind of a move, I fear, I say, because that in turn will give rise to market distortions, as we found in 1989-90. That started the Japanese market collapse. And if they do intervene, it'll weaken the dollar, but it'll cause absolutely new problems for the global markets.
Right. And you mentioned that, I should note, as the Dixie, the dollar index, hits a fresh 2-decade high, breaching 112. Dana, in a world in which a 10-year yield goes 4% or higher, what is the appropriate valuation for markets? How do you think about that and where we are right now? Because we're at right about 17 right now.
Yeah, no, I think it's a really important point, and maybe what gets lost a little bit when we're looking at just the technicals and what's going on in markets and how the reaction is happening real time because rates are moving so high. But the long story here is that we've had 10 years of essentially free money, right? And if you just look at all the empirical evidence we have on markets, how markets behave, decades of kind of research have surfaced basic fundamentals that you can count on in markets over the long term, right? That really haven't been upended. They looked like they were upended for years because money was free, but we move back to that reality where price does matter, right? Valuation does matter. And then you add to that the fact that we're moving sort of out of this era of globalization into a world where we're all spending more on defense. There's not as necessarily the ability to have the most efficient, cheapest supply chains. Now it's going to be, we want to protect supply chains, et cetera. So that also suggests that multiples over time are maybe going to come in, that the inflation rate maybe settles at a little bit of a higher rate than we used to experience. And you do have to take into account when you're investing, what does that mean for expected returns over the long haul? And what does it mean for what types of, what companies I'm willing to invest in, what types of companies, right? So an example on that, think about these small growth companies where, they're just this side of being in the public market to begin with. They look like private equity almost. And even some of the private equity deals we've seen in the last several years, the sort of stupid multiples that have been paid for companies where, profitability is just not even in the picture. And what does that mean now? So if I'm a public market investor now and I'm looking at stocks and I want to be diversified, I would look very long and hard, one, at diversifying and two, at, what is the profitability, right? What are the fundamentals that I should be paying attention to? The price I'm paying, the profitability of that company, and diversifying across and not taking the idiosyncratic risk. Because we know in down markets, there's a lot of dispersion in return as well. Companies, that would maybe kind of survive don't survive anymore.
Right.